Welcome to topic 5, the income statement, part 1. Firstly, just to give you an overview of what we're going to cover in topic 5, we'll have a look at the purpose of the income statement, and also we'll have a bit more of a look at income and expenses and how they operate inside an income statement. We'll explain how accounting concepts influence the income statement. Then we'll have a look at depreciation, how do we calculate it, what are the two different methods that we can use to calculate depreciation. And we'll briefly introduce you to earnings management before moving on to look at the different income statement formats. Then we'll get right into it and look at how we prepare an income statement, and then also we'll show you some basic interpretations that we can make from an income statement. So starting off with part 1, we'll just focus on initially the purpose of the income statement, and then we'll have a look at income and expenses in a little bit more detail than what we have previously. So firstly, the purpose of the income statement is really to tell us all about profits and performance, because in a lot of people's eyes, how well a firm is performing is really, well, how much profit did they make? Did they make heaps of profit or did they make a loss? So the income statement measures and reports how much profit the business has made over a period. We can also use the income statement to evaluate past decisions and revise future predictions. So we can look at this statement and see, okay, how much did we spend on advertising? Is that up from last year, or is it less than this year, or is it around about the same thing? Okay, so we can have a look at some of our spending patterns and also our income patterns, and then we can make decisions moving forward into the future. Now, the statement for our income statement, we have touched on this one before, and just touching on it again. Profit equals revenue or income less expenses. So this one is a really important formula. You do need to know this one because you're going to be using it quite a bit in this course. You can abbreviate it down to profit equals R minus E. Income and expenses. So the way we can define income or things, what income includes, is that it's revenue that typically comes from our operating activities. So our operating activities are those activities that are really all about why we exist. So what are we in the business for? Are we in the business for advertising services? Are we in the business for selling fluffy bunnies? So the money that we generate from that, that's our revenue. It's like our bread and butter. We can also generate income from other sources. So that can include interest. It can also include dividends as well. With our expenses, so these guys, they're outflows of resources, generally cash and other assets, and they flow out when or as part of us generating our income. So we incur expenses as part of us earning our revenue. With our expenses, we generally break them down into 4 categories. So that includes cost of sales, selling and distribution, administration in general, and finance and financial. Now, to put some definitions around these terms, we define revenue as increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity other than increases resulting from owner contributions. So one thing to be aware of, if say an owner contributes $10,000 to the business, that is not revenue at all, okay? That's an owner contribution, and that's going to go off into, say, our capital account or equity accounts, whatever is appropriate, okay? We recognise our revenue in the accounts when we can measure it reliably, okay, and put those dollar terms on it as well. So revenue can arise from an inflow of assets. So most commonly, that's going to involve our cash or our accounts receivable. So if we take, for example, if we receive cash for some services that we perform for a client, that's forming revenue because that's an inflow of an asset, inflow of cash. Another example would be we perform some services for a client on credit. So we've done the work, we haven't been paid yet, so what's forming here is an accounts receivable. So an accounts receivable, that's also an asset. Alternatively, though, we can also, revenue can come about through a decrease in liabilities. So this one's not as common. And an example would be we've received some revenue in advance, say from a customer, say they've paid us $10,000 in advance for work that we haven't done yet, okay? And then what will happen is over time, as we perform those services, we will gradually earn that income. But in the first instance, say when we receive that $10,000 and we've done nothing for it, that's actually forming a liability at that first point in time. And then over time, as we earn it, that liability will reduce and our revenues can increase because we've earned the work. Now moving on to our expenses. We can define expenses as decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or increases in liabilities that result in decreases in equity other than decreases resulting from owner withdrawals or dividends. So another key point just to be aware of, if an owner takes money out of the firm, okay, or they would do drawings, that's not an expense, okay, because you're not incurring that in the process of generating your wealth, okay, or generating income. All right, so any owner drawings, any dividends paid to shareholders, they do not form part of your expenses at all. Now we can record our expenses in the account when we can, again, reliably measure them. But one thing to be aware of as well is that it does include estimates. So estimates in accounting are not complete guesswork. We do have guidelines around how we form estimates so that there is some reliability in there. All right, so please don't disregard an estimate as something that's useless and dodgy. It's not. Like I said, we've got guidelines that help them come together. Now, an expense is a cost that's incurred as part of earning revenue. So with our expenses, they'll be matched either with an outflow of an asset, generally most commonly cash. For example, say we paid insurance expense in cash, or we have that increase in a liability. So for example, we can have rent expense that we've incurred, but we haven't paid it yet. So what happens is that's going to create the liability, rent payable. All right, so we've incurred it, but we haven't yet paid it. So because we haven't paid it yet, that's why it falls into the realm of liabilities. Because as we know, a liability is money that we owe to an external party. Okay, so that's a little brief overview there of the purpose of income statements and also a closer look at revenue and expenses.